Amazon runs lots of the studies where they try to, if they'll give you an option to do a green package and not even charge a premium, and people still
Right.
don't select it, right?
No.
And so,
I'll
so
tell
I
you, my
think you're
wife
right.
certainly does not select that option if it takes longer to arrive. She's certainly not picking
Exactly.
that box. Let's start with a little bit of bio or a little bit on who you are. Maybe the like the canned if you were at a conference and had to kind of dive in on what you do with someone who probably is probably has very little to no idea what you guys spend time on, and take it from there.
Yeah, yeah. So I'll talk a bit about what we do and then a bit about how we got here. So our firm, Cresta Fund Management, we really focus on energy infrastructure primarily, and our fund series are split historically between more conventional midstream and sustainable infrastructure. So really looking at areas that are a little bit off the beaten path for maybe some of the big infrastructure firms. So we're not really looking at utility scale solar and wind. We're looking more at areas around logistics, agriculture, industrial chemical waste, waste upcycling, things like that. So it's been a really great run. Yeah, we come here. So I started my career with my two partners as kind of a founder and an operator. I guess going back before that, I did my investment banking analyst stint, which I think
Yep.
is obligatory.
That was kind of during that same. It was kind of like that .com boom type era, right? Like we had a quite frothy market. It's a good time to be an analyst when the market is frothy.
It was, yes, and Dallas was unique, right? I was in Dallas. I was at Bear
Oh, okay.
Stearns. Bear Stearns did not have a Houston office, and so the energy work was
Oh,
done out of.
interesting.
And so I sort of split time between the generalist practice and the energy practice. Really enjoyed the work that we were doing around the energy side, and decided that's kind of where I wanted to spend my time. So I don't know that I was a great analyst. I certainly learned a lot, but realized that track wasn't for me. So I left and joined TXU right during the heart of deregulation. So uh, the company was just sort of working through what it meant to go from a
Yeah.
regulated utility to this sort of new unregulated market. Enrollment was flying high. Everything was
Yeah.
sort of changing fast. And I joined the strategy group initially and then bounced around a bit, ended up in the trading group, learned a lot. It was a fascinating time. Actually was kind of ancillarily involved in a wind development that was going on in West Texas through the trading group. Saw a lot of power plant development, and just kind of learned how energy systems worked at a really big level. After doing that for around 5 years, I joined what was essentially a startup. It was a company called Regency Energy Partners. The company was privately formed. They were backed at the time by Hicks Muse in Dallas, and had a bit of a war chest to go out and acquire midstream assets from utilities. Right, this deregulation had led to this kind of mismatch between
Sure.
regulated assets and where they were trading versus these potential for these new sort of unregulated gas and ultimately crude and fuels and chemicals assets as well. And so we started on a bit of a buying spree and built a really great company around.
Yeah. It ended up becoming quite a big business.
It did, yeah. I think we ultimately sold the business to Energy Transfer. I think the enterprise value was maybe around 3 billion at the time. Started with $100 million equity commitment, so it was a lot of
Crazy. Yeah. A
yeah.
lot of capital raised and hopefully a lot of accretion along the way, right? Yeah.
Yeah, it was great. I mean, I think the Hicks Muse folks did really well, and had they stayed in all the way through the end, ultimately they sold to GE, who came in and
Okay.
wrote it. I think they would have made over 10 times their money had they stayed in from beginning to end. As it was, I think they did pretty close to that anyway. They did really well. So.
Those early midstream sort of businesses just knock it out of the park in terms of like total return capital. It's sort of insane. Forget about upstream for a moment. There's a couple incidents of those, sort of knocking out of the park, but it feels like if you go look at those midstream returns of all these public companies that you see today, and then kind of go back to their origin story, it's kind of wild.
Yeah, it was fascinating to see this idea of kind of like the general partner and how it formed and how it was somewhat taxing the limited partners. And it was, I don't think super well understood initially. And so it created
No.
some interesting incentives, but it did lead to some astounding returns for sure.
Yeah, low interest rate for quite some time. So if you had like retail investors in the LP stack, the GP, yeah, and then they get the secondary waterfall and all these sorts of things. So
Yeah, I think there was a period where the utilities were trading at 7 or 8 times EBITDA, and the MLPs were trading 14 times EBITDA, and that arbitrage could be hammered.
That was the whole argument, right? Anything you could put into an MLP, let's go do it. And then it got a little too far with sort of upstream MLPs that require insane amounts of capex to just keep production flat. It's not really, the right answer.
Yeah, and we were always a little bit hesitant, even on the upstream, sort of midstream side, right? You have gathering systems, and what is a maintenance capital requirement if you have to maintain distribution? And I think we did a pretty good job of walking the line, and again, it was a great return.
Contract term, like what's the contract structure? Is it fixed fee? Is it pop? There's all these sort of considerations that all sort of move towards, okay, here's the ideal sort of contract that would get valued in an MLP business. And so all of a sudden, all of the GNP projects sort of mirror that, right? Like they all mirror the exact same structure.
Yeah, and so then we sold that business in, I believe it was 2010, to Energy Transfer. At that point, my two founding partners of Cresta and I left Regency, and we formed a company called Wildcat Midstream Partners with a couple of other folks. And there we invested, we had institutional capital. It wasn't from private equity. It was from a large insurance company out of Boston primarily, with some family office dollars and some of our own dollars as well. But we invested into a couple of sort of greenfield developments that we built from scratch. So I was the CEO of that business. David Miller was the chief operating officer, and Drew Armstrong was the chief financial officer. And so we built that business up, sort of sold off the components. And then at that point, we really decided to form Cresta, which is the private equity fund. And a lot of what drove us was, as we were looking to raise capital, as founders, it was apparent that most of the people in private equity are lifelong finance folks, right? They really don't have necessarily operating experience. You see in the venture capital world, you see a lot of founders that find their way into VC firms. You don't really see that in the infrastructure world or the
way less common.
Right. I think it's sort of how these firms were formed. If you think about, a lot of the infrastructure firms, it seems like most of those founders came out of project finance at some point, right? A lot of the Macquaries of the world and the European project finance banks kind of spun into this infrastructure boom. And so there was a lot of capital there, but it wasn't particularly founder friendly. And then the founder friendly capital that was there doesn't really know how to invest in big infrastructure assets. And so
absolutely not.
An opportunity to maybe bridge that gap and bring sort of our founder experience combined, with our background around private capital, and launch a firm that was a little more founder friendly.
And so when you think about that, like that is a highly uncommon, I think we talked about it. It's a highly uncommon progression, right? Like if you create a Venn diagram of energy private equity firms that are namely, the GP is all folks that have started a company before, and generally a private equity backed, operating business, not a, more digital venture or something. And then have at least several $100 million under management is quite low. Have you found that thesis to pan out in terms of, if you're looking for management teams, Do you think the founder friendly helps on the front end, or do you think it's just something that has helped while you're during the course of the investment and either course correcting or trying to help, sort of after the fact, if you will?
Yeah, I mean, I think it helps in a lot of areas. It's surprising to me that it's not more common, right? Because there's a certain amount of skills and requirements to managing capital, right? You're a registered investment advisor. You have certain SEC regulations. You have to be very thoughtful. You've got fiduciary obligations. You're having to sort of weigh those in. And those skills are very meaningful and valuable, but those skills also exist inside of a lot of corporate environments, right? A lot of CFOs came out of investment banking. Um, in the investing part of the business, though, there's so much more needed than just those skills, right? You need to understand the underlying businesses. You need to understand the commercial markets. You need to understand the operating environment, hiring, staffing. There's just so many disciplines that are needed to get up the curve on that it just surprises me you don't see a lot more founders and or business managers, if you will, moving into the sector. So I think it's helped in a couple of ways. One, it definitely helps on the front end in both, I think, attracting very good teams that we're able to speak a similar language and we're able to kind of walk their own experience and appreciate some of the struggles they may be going through that really aren't related to the core business, but just those ancillary things like how do you do payroll and how do you get rent set up and AP and AR and those things. I also do think it helps along the way. We tend to invest in a lot of businesses that have some kind of growth or construction element to them. And I think without construction experience, it would be very easy. I mean, even with our experience, we found ourselves at times in hot water where you're sort of not managing it every day. There's another team there, so there's only so much you can do. I struggle to think, how we would approach it if we didn't have that experience. And so that experience gives us the ability to jump in if necessary, lend a hand, even take the reins if absolutely necessary. And I think that's been critical for us.
That was going to be my next question is, on the founder side, I think you have this undying urge to be intimately involved in every detail of the business, which is tough if you are potentially on the manager side, and the goal is to sort of be a little more laissez-faire or give out autonomy. How have you balanced that? Because I suspect there's a part of you that wants to spend a lot more time in the nitty-gritty on a lot of these businesses.
Yeah, I think you balance it through trust, right? You have to find people that you trust and that you believe they're evaluating and viewing the underlying environment the same way as you would. I think it's one of those sort of tough questions because we were talking about this internally the other day. What's different between being a private equity investor and being part of the management team? And I think it's just that finger on the pulse is very different. When we were, running the business, I'm sitting across directly from our customers. I'm getting to see their face. I'm getting to see they may be saying yes while shaking their head no. And there's no way to actually interpret that from 2 or 3 levels back. So when we're hearing at a board meeting a recount of a customer meeting that goes on, it's just much harder to actually glean anything other than the color we're provided. So it really comes down to trust. And so what I think we've learned to pride ourselves on more recently is evaluating the people and not the underlying business. Early on, our tendency was exactly what you described. We would look through the management team almost to the underlying business and say, oh, I can see the merits of that business, and I can accept that this team is their first time doing this and they're inexperienced, and that's okay.
But you love the business idea, or you like the business model, and you fall too in love with the base case business.
That's exactly right. And I think we've sort of seen that sometimes play out well, sometimes not so well.
Yeah.
So now we're really more focused on the personnel, those individuals, that CEO. And it's not necessarily that we want someone who's done this 10 times, but there's a certain personality type, a certain sort of qualia that we're looking for.
You can probably tell within 10 minutes of either the sort of folks that you're like, okay, this is going to work or it's not, right? Like it's a very weird metric. And then also the stage that you're in oftentimes is more of a back and build sort of strategy, as I understand it. And so there may be 2 or 3 pivots before you get to the, within the box, the exact business plan, which is very different than someone who's coming in with an existing business and trying to put in a big check and just kind of scale up what they've already got working.
That's right. We have to be very, very judicious with capital early on because there are so many avenues that can pan out. And then when certain doors sort of close out, if others aren't opening, then we need to cut that capital off.
Mm-hmm.
However, what you usually see, as you described, is you may have 2 or 3 ways you think it's going to pan out early. We're investing at that point hundreds of thousands of dollars, right? We're not millions of dollars. But as you start to see 1 or 2 avenues become more promising and you start to hit some milestones, you can sort of lean into that. And then there becomes this point of no return. We call that the final investment decision, FID. You have everything at that point that you need to move forward, and you either do or you don't, right? And for us, there's an acceptable amount of loss ratio there that we can get something to that FID point and shut it down. Once we go through that door, though, we really don't have any capacity for losing money. Yeah.
So when you think about that, let's say project agnostic or team agnostic, is that generally structured? There was an era where it was very much like 3-man management team and a truck, and here's 18-month, 24-month leash to go out and hunt and pitch us everything you can possibly find. Do you find that to be the base case, or is it a lot of, hey, we can simultaneous close on some asset that sort of jives with the thesis, and we'll work for free until we get there? How do you think about the right positioning for both what you guys want as a fund and what puts the management team in the best possible spot as well? I think.
Yeah, I definitely don't think the 3-man in a truck model is as likely to be successful today as it was 10 years ago. But there are some versions of it that do make sense, right? So what we normally see is one of a couple of things. Either someone has developed an opportunity on bootstrap dollars up to some level, right? That could be the office, could be their own capital. And really what they need at this point, maybe they have the engineering largely completed, they've even had permits ready to go. But in order to get that commercial contract, they have to have some kind of financial backing, right? Mm-hmm. Because the customer is a sophisticated, off taker, and they're not going to sign that without that backing. And so
money
that's
is sort of the bottleneck to the next milestone for them to progress the business. Yeah.
What actually tends to happen though is you get there, but there are 1 or 2 almost there's that aren't quite there. So the permit maybe still needs another 7 or 8 months of maturation. Maybe there's we have an engineering pass, but there's no fixed contract EPC firm willing to fix the cost. So we have to now go in and do a second layer of analysis on the cost to how much capacity do we have for it to go over. So what we're looking for in the management team, and because of that, right, there's kind of, I'd say 3 factors that we're weighing when we're meeting that management team. There's a credibility question, right? Is this management team credible in this particular instance, right? They may be very credible in something else they've done, but here maybe not, or maybe they are, right? And it doesn't necessarily mean they've been in this industry for their whole career. They just, for whatever reason, they have strong credibility. The second is, do they seem to be a reliable bunch, right? Is this someone that once you sort of hand them the keys, they're going to hit their milestones. They're going to make it happen, whatever it takes, right? They're going to keep driving and driving. And that's different than being credible. You can absolutely know your space, but ultimately not show up in the morning, right? And so you want someone also reliable. And then the last piece is, do they have a sort of an understanding of the qualitative aspect of their business, right? The more kind of empathic, or are they able to sort of deal with the human factor, right? Because when you're building a company, you get to hand select the first few folks, and then they kind of
then they scale accordingly
around you, right? And you need to be able to speak human to be able to drive growth. And we find that not everyone who's credible and reliable speaks human, right? So it's really amazing when we find those teams that round that all out. And I think we've got a pretty good success rate there.
Have you come across, so those are 3 really interesting dimensions. Are there any sort of immediate green or red flags one way or the other? You don't have to be super specific, but like, Is there something that someone comes in and says or does that like is just okay? We're gonna have to work with this person, whether it gets to the finish line or not is sort of irrelevant. And then call it the inverse of that.
Yeah, that's a great question. I mean, certainly, being organized, knowing the story, being able to take oddball questions. Sometimes we'll ask questions, right? Not because we even care the answer, but what we're really looking to do, see how someone responds to being challenged. And I think that's probably a red flag, is someone who really is in this mindset where their identity gets hit if they feel like they've
Yeah.
been challenged assumption. That
Yeah.
can be a real problem, because that's it's hard to see that change over time. We really like someone who's a consummate learner, right? They're always looking
Yeah.
to learn, and they look at a challenge to their assumptions as a way they can even improve their assumptions. And when we see someone take those challenging questions and become curious about the answer, that's really positive. But I'd say that's the biggest red flag, is when we challenge someone and the defensiveness is very apparent and they don't want to be challenged. You weren't supposed to go to that page. We're on page 11, not page 13, right?
Yeah.
That's one.
Yeah.
And so that can be, again, intentional, right? It can be a little bit
That's
of we're
right.
testing qualitative aspect.
That's right. It could be a green flag if you were completely a non-control investor or something. Like I could see why that might be like valuable, but if you're gonna be control private equity, like that's got to be really tough. So like this guy's not gonna answer my call. Got a problem, right?
Yeah,
So I guess a little
I would just
unique.
say it's one aspect, right? It's not certainly again. There's multiple dimensions here. But I would say if we're going to sacrifice a dimension, that's probably not the one we're going to sacrifice.
Yeah,
At the end
yeah,
of the day, I'd rather have someone who's learning an industry, but they're reliable and very high EQ, than someone who knows this industry inside and out, that no one will return their calls. So
right. Yeah, yeah. So okay, so you and the management team have known each other and worked together for an extended period of time, a long period of time, which is always you know great to see. Do you find that most of the management teams that you guys have historically backed, let's say, call it your first cohort or now even today, do you think those are led by folks that you've already had you knew them prior to starting the fund, or have a lot of them kind of come in and been introduced to the firm over time?
yeah, it's a great question. So I would say almost all. I mean, certainly more than 75%. There's some history relation with someone on the team, right? We've met in the past, maybe worked across from each other in the past. Um, Now, because we are in sort of a growing sector, especially on the more sustainable side of our business, you don't find people that have been doing the same thing for a decade, right? Because it just doesn't
Right. Yeah.
exist.
Yeah.
But you do find people that have worked together for a very long time. And so I would say, like, Lapis is a great example of a team, and that's our carbon solutions platform. Very exciting business. But that team, the core team, has worked together for a really long time. They came out of Cosmos Energy. I think some of them have worked together even before that. And so you can definitely feel that history they have with each other. And they've added people to that team over time, and that culture is continually migrating and changing. But it's good to have that really deep common thread. We've invested in other companies where the management teams themselves really didn't know each other well prior to coming together. And I would say I was more optimistic that that would be successful than it has been
Yeah.
in real life. So we do like to see that either we have a relationship, or at least the team has quite a bit of history with each other.
Yeah. That makes a ton of sense. I mean, it is a weird industry in the sense of like so for example, if you've talked to someone, let's say 7 years ago, and you've met them and you had no more than just like a friendly intro conversation, and nothing happens, but you reconnect with them 7 years later, it almost feels like you've known them for that period of time, even though like it's been a half an hour of knowing each other, right? And then 7 years of pause, and then you got to it. So it is weird that we associate it that way, but it's certainly the case, and it feels that way, at least in my relationships in the industry as well.
I agree, and I think part of that may be just folks that have come through energy, right? We have a lot of the same battle scars, right? If anyone went through 2008 We all felt $140 oil go to $30 oil in 6 months, right? Anyone that went through April of 2020 and saw negative
Yeah.
crude prices,
Yeah.
right?
Yeah.
You may not see each other, but you certainly have a lot of the same wounds when you come back together.
That's right. Okay, so okay, we'll switch gears a little bit. We talked about some of the thematic stuff that was happening recently, at least with policy, tariffs. Yeah, there is a very large administration change, so there is a as much as we've spent a lot of time thinking about sustainable fuels and a low carbon economy, a lot of that was underpinned by, let's say, policy decisions, IRA decisions, and then even if you put aside the policy. I think there's just a viewpoint that there was going to be infinite mega fund capital to come in and buy out businesses that were potentially unprofitable. And if you just go take a look at, call it the SPAC index of energy transition and low carbon businesses that are not profitable, they trade the way like someone who would have cautiously told you 3 years ago would tell you they would trade, right? They don't really trade at a premium. No one is really buying the future growth potential. And you can make the argument that rates aren't that high and are probably going to go down a little bit. So anyway, a loaded sort of stage getting into it. But what's your pulse on like where we've been, where it looks like today, and where you think we might go?
Yeah, no, I think you hit on really the heart of it. So I sort of start with, I think a lot of people who aren't in this world every day hear the policy debate around climate and they sort of have this impression that half the world is a climate alarmist and half the world is a climate denier, right? And it's just this battle between the two. But I don't think that's really what you see in the data. Yale has a really good framework they call the Six Americas framework for how people view climate. And what you find, which is pretty interesting, and I think it actually tracks with my own experience, is you've got around 30% of people that are true like climate alarmists and another 30% of people that are very concerned about climate. So like talking 60% of the country feels like climate change is a real issue. And you have
Yeah.
about 20% of people that are either dismissive or absolutely just denied that there's an issue, right? Say there's just not a problem at all.
Right.
So
Yeah.
and the remaining 20 are generally disengaged, right? They just don't
Right.
care or they've never even heard of climate change, right? And so that tells one story, but when you really break it down, I think you get into what the real debate is. And that is, it's only that 30% that are the alarmists that will tell you that we have to, invest in climate mitigation at any cost, right? Everyone else, the entire 70% of the rest would say, no, I mean, there's some like cost that we're not willing to pay, right? And that's really, I think, where this ultimately breaks down. So I don't think that anyone in the world wants to harm the environment, right? I think there's a question one. There are people that legitimately question whether the science says that climate change is man-made, and I'm
Right.
not a
Yeah.
scientist in that debate, but there are people that question that. But I think there are many more people that say even if it's not, it's out in the future, it's a little unclear, the trajectory is not mapped, and the cost could be enormous. And how do we make
Yeah,
all
of the
that
10
foot?
priorities that I've got in front of me as a citizen of the United States, it doesn't hit the top 10. I'm not familiar with the study. It sounds like something to look into. Yeah, it feels to me like that 20% disengaged is probably a lot larger. And by virtue of
Yeah,
not even participating in the survey, like a disengaged person does not care, right? Whereas the alarmist is going to, by definition, be like, oh, yeah, sign me up for the alarmist box on the study. So I
right.
suspect like
Like
both
most of
ends
these
are a
studies.
little I
Yeah,
suspect both ends are a little loud, right? Like the alarmist side is loud, the denier side is loud, and I suspect
that's right.
80% of people actually sit in the middle and are like, I mildly care, but like, I care enough to pay maybe a small premium to I don't want to pay any premium ever, right?
That's right.
And,
That's
and
right.
the premium I'm willing to pay is to have clean air and water, and then like sort of sans that. I'm not sure I necessarily want to pay an extra 10% for my Southwest flight.
That's what the math shows, right? And that's actually what the marketplace shows. Amazon runs lots of the studies where they try to if they'll give you an option to do a green package and not even charge a premium, and people still
Right.
don't select it, right?
No.
And so
I'll
so
tell
I
you, my
think you're
wife
right.
certainly does not select that option if it takes longer to arrive. She's certainly not ticking
Exactly.
that box.
People start to associate that it will cost something, even if it
Yeah.
doesn't. So I've talked to someone at Amazon that run studies, and they've actually done this to see without even changing it, just putting the label on
Right.
and avoid it. And so I do
Yeah.
think that's the real question is the cost, right? Because I don't think anyone wants a bad environment. Right? No one.
No, no.
We want clean water, we want clean air. And so really what it comes down to, I don't think it's any coincidence you sort of started with this, that the net zero 2050 idea came about during this period of zero interest rates, right?
100%,
And
right? Like, yeah,
it
yeah.
was a different world. But when we come to today and say, okay, well, if that's really the real crux of this, then I don't think it's a big coincidence either that where there tends to be minimal political controversy is where it also tends to be economic to invest in climate mitigation. And that's where we try to spend our time. We call ourselves pragmatic, innovators, right? We don't want to be at the very forefront of the bleeding edge, but we do want to invest in things that can have a real positive impact provided they can do so economically, right? That it's going to be economic in the environment. And we see that in areas like there's certain areas within carbon capture where I think it's pretty low cost. There's certain areas that it's higher cost. I think in a lot of waste management, waste upcycling, we're seeing folks that have found really innovative ways to take, discarded plastic and pull the carbon out in ways that it can be used to make things like graphene, like very high quality components. Biofuels right now, I think it's a little TBD on that, right? I don't know where it shakes out over time, but it's not very politically controversial, but right now the cost is pretty high. And so I think where that changes is things like cover crops. We see camelina and pennycress and these interesting weeds that can grow and be used to make energy products. But that's our view is that ultimately this debate is about economics, and
Right.
you have to really understand the economics to know where to be every day.
Yeah, said another way, it's like if you could strip away the business plan and say this has nothing to do with it being, good for the environment. And in fact, I won't tell you exactly what we are doing. This is just the mechanics of the business, right? Like here are the underlying economics of the business. We buy feedstock from company A, we process it this way, it produces product at that we sell to company C, whatever. And here's the underlying economics. Would you invest in
Yep.
this business, right?
That's it.
And if you check the box, yes, it's probably a pretty good business. If you can't check the box without putting this narrative on top of it, it's probably really, really difficult for this pool of capital. Now, are there other pools of capital that might be interested in putting money to work there because there's some potential asymmetric upside or scaling or whatever the case may be? Sure. But my suspicion is for private equity style returns, really tough to make a narrative pitch work.
That's right. That's right. And I think that's a lot of the issues you'll see around whether certain institutions, are coming down on sustainable oriented companies. It's a question of, are these fiduciaries making decisions just around returns, or are they adding these other layers of decision making in? And so I would say that of the investors that we talk to, it's a pretty small portion that truly is looking for impact, and it's not zero. It's a meaningful amount of capital, but most are looking for that business plan to work. And I just don't believe that we have to. They're not mutually exclusive, right? There are lots of business plans that work and also do really good things for the environment, and that's where we spend our time.
Yeah, I think we touched on this a little bit, which is there was a ton of capital that was raised in a low interest rate environment that was expected to buy out businesses that were built by private equity firms. And I think, did those businesses get to a point of producing enough EBITDA to be useful, interesting, whatever? I think what's kind of crazy, and I think the last 6 to 8 months, maybe a year, has sort of shifted that, which is, the concept of nat gas power gen all of a sudden became sort of clean enough, if you will, for a lot of these infra funds to come in. And like the cash flow profile has always sort of fit infra style returns anyway. So that was always the case. And so now, like, if you go look at like the last 10 big infra deals in this country, it's almost all universally just changing hands of old vintage funds owning nat gas power gen, or like, some utility owning something and getting it off the books or whatever. And it's like kind of, I certainly didn't have that on my bingo card when we went through the pontification of what 2024, 2025 would look like, in 2020. I think the pitch was very different, which is we'd have 4 giant multi-billion-dollar carbon capture businesses in this country, or we'd have 4 or 5, very large sustainable aviation fuel or e-fuel type businesses. We haven't seen it yet. I mean,
We
perhaps
have not.
they will come, but we haven't seen it yet.
I mean, I think there's still a home for those things over time, but it's very small, right? I think what we've seen is a tremendous amount of effort put into lowering the marginal cost of producing, a megawatt of power with
Yep.
solar, and
Yep.
the drop in price was tremendous. But there's limits of chemistry and physics that just sort of make energy storage difficult.
Right.
And I think
Yep.
that's ultimately the difficult part for renewables. And that's where natural gas, at one point was, the question was, is this a transition fuel or not? I think people at first will say no, we've got to get away from all carbon, all fossil fuels. And I think looking at the alternatives, given the cost of energy storage, it's like, well, again, there is a cost where we can pay and a cost we maybe can't pay. And suddenly you see gas coming right back into the limelight. And
100%.
this power need is massive. And so
Power needs
I would
huge.
say, yeah, there's another aspect too that is, I think it predated this administration, but I think this administration is trying to shine a light on it. And that is this sort of growing security premium on energy as well. If you look back, I think China, if you think about when their peak on fossil imports, right? When was their
Right.
peak year? It was 2019. Or they've been declining their imports ever since 2019, moving into renewables. They have a massive percentage of electric vehicles, right?
An
And so
insane
they're
number
pushing.
of nuclear plants, right? They're building like a nuclear plant a day right now,
That's
which
right.
is like,
Yeah.
the American mind cannot comprehend that degree of
That's
like
right.
brand
Yeah.
new, like greenfield
Like one of
construction
those
and manufacturing.
memes, right? Yeah.
Yeah,
When I
exactly,
would say
100%.
again, that's not, and that has nothing to do with the Paris Accords, right? That is
No,
absolutely
no,
about
no. They're just like, we want
security.
power. Yeah, we
That's
want
right.
power. Yeah,
We want to control it. We want it within our borders. And I think in the U.S., because we do have this, huge amount of natural gas and large amount of oil,
yeah,
there has been a growing recognition that, hey, we maybe need to prioritize security in a world that's becoming sort of less secure over time. And I think that also has created this security premium, much like a green premium was talked about a few years
yeah,
ago, right? And you and I were talking about this earlier, but I've seen a good analogy made where you can sort of look at a tariff as being a security premium, much like a carbon tax would be a green premium sort of driver. And I don't know how that plays out over the next couple of years, but certainly it's likely to lead to further driving and pushing of our use of internal resources in the U.S.
yeah. I mean, look, if you have confusion about where products that are made internationally trade, then by very virtue, like you'll be far more interested in investing in the United States, right? And you will invest so at a slight premium, right? And we seem to be the case. The security piece is also interesting because security is almost an extension of reliability, and so like the data center piece has always been this concept of, well, just so you're aware, right? We need a ton of power, we need it all concentrated, and oh, by the way, it has to be extremely reliable, and we have to have like 2 layers of redundancy. That is a unique element to load demand growth that we have historically not had, right? Now, the forecasts seem to be quite absurd, though. Like if you sort of look at like the forecast level, I think it's it can be a little nutty. And I think it's a little nutty for a different reason, I think, than call it popular narrative. And so popular narrative is just like, okay, we need a bunch of load demand that results in this much BCF of gas coming online a day. We're going to, mothball this much coal. Like, okay, yeah, I think there's an argument there. I think what is confusing about data center demand is that one, nat gas is like extremely energy dense. Like I think a lot of people like don't understand that like one new Haynesville well is like, a 200 megawatt power plant, which is then powering like sort of an AI cluster today that, Elon Musk has in Memphis that is, built the greatest AI model so far on a training run in 120 days or something like that. Okay. So that's like kind of where we are in terms of like peak today. Right. And so now the view is, okay, all these big, Oracle's going to come in, and 10 other highly capitalized tech companies with $1 billion plus balance sheet or market cap, or $1 trillion market cap, are going to come in and invest, $80 billion a year in capex, which is like, kind of silly to say out loud, right? Like, I don't know where Oxy's market cap is today, but like, let's say Microsoft is going to buy an Oxy worth of, capex in data center today, and you're like hypersensitive to that. But I think what folks don't really think about is, okay, great. Let's say the power and the gas is, a couple $100 million. The data center itself, the shell of the building, is like $1 billion. But what I think gets underestimated is the amount. Do you know how much money goes into so let's say you and I build a $1 billion data center facility. Do you know how much it costs to get the NVIDIA chips to put into that $1 billion data center?
No, tell me.
It's about 10x that. So
Wow.
I need $10 billion.
Wow.
I need $10 billion to put into that facility. So I think we sit back and we're like just thinking about the power and the gas and the data center development. But I think when the question becomes financing, we need financing. The financing is actually really for the most expensive part, which is the NVIDIA chips. Now, let's talk about the asymmetric sort of bet there, which is, okay, I need $10 billion to buy a bunch of GPU chips. And like they don't, they're going to be obsolete in 4 years. And if I decide to pull out of this deal, that also probably means that everyone else is pulled out at the same time, right? Because the cat's out of the bag that the AI capex return is not necessarily there, right? And so we still haven't seen. I think the fundamental question is like, is the ROI there on this capex that's being spent? Now, I believe, AI has a bunch of productive use cases, and I'm quite bullish there. But that doesn't necessarily translate to market returns and cash flow returns.
We're at this early day where monetizing AI is unclear, right? I mean, it's I can't imagine what I paid for ChatGPT covers what you just described, but maybe it does. But
that's the tough part, right? Which is if Microsoft's planning on spending $80 billion of capex, so just think you're someone who's spending $80 billion of capex, you got to be thinking that you're going to get 200 billion back in cash flows incrementally over some period of time for that.
Yeah.
That's the question mark.
I mean, I guess the one area that and this is something as investors we're thinking about, how can we be relevant, right? Because we're not really AI investors. I'm not a power investor per se, but what can we be relevant? And as I think through where that could grow, right? You do have this push towards reshoring everything.
Right.
It's tough right now to compete labor for labor, against us in Southeast Asia. But if you can automate and use AI and create dark factories and those sorts of things, you could actually see reshoring a lot of production.
100%, right? Like it's just all robotic built, and that's effectively Tesla's case. If you go like any Tesla factory in the United States, is all just state-of-the-art robotics and automation that's building out vehicles, right? And
so that makes it competitive. There's a business case for business-to-business AI that probably fits in that model somehow. Again, it's an area we are still coming up the curve on. I guess the area, or one of the things that makes me a little cautious though, is as deep and big as these energy markets are, they're always pretty thinly balanced, right? That's the other thing I don't think was just how we saw it in April of 2020 when we had
just a mild sensitivity skyrockets down, right? Like
all dip in demand led to negative oil prices, right? So I do wonder, I think back to 2005 and Hurricane Katrina hits, and we've gone from a world where natural gas was $1.50 to $2.50 pretty reliably within that band for years. It was $15 an MMBTU, and it sort of changed the way we think about natural gas scarcity. Now, with the Haynesville, like you said, we can ramp up much quicker than we could then, but it's not infinite. So I do worry that there could be a little bit of a self-limiter where as we start to build that demand, you will have a price response. At some point, that price response starts to test against the limits of the ROI, and that
We're
could take.
seeing it on oil.
Yeah.
So, and now part of that is a confounding situation of inventory quality and consolidation, and part of that is pricing, right? The security thing and the tariff thing is actually quite fascinating, right? Which is, okay, well, if we want if we want security, there's an argument to be made, which is like, hey, we have this incredibly valuable fuel, we should just keep all of it to ourselves. Like is an argument. And the problem is like that's not the case, right? Like we export certain types of oil out of the Gulf Coast for a reason, right? Like we don't want condensate here. And then LNG permits are like sort of getting approved finally. And so now those things are going to be online, and that's a huge demand driver. But like it is actually interesting to think about it, because if you make the security argument, you would sort of axe a lot of those projects. And now that would drop, again, goes back to your demand response, right? It's so thin that if you turned off Eagleford condensate export and you turned off LNG for a long enough time horizon, you would just demolish pricing.
Oh yeah. Oh yeah. No, I think what ends up happening though is there is a security element. I think the exports continue. I mean, Europe is particularly vulnerable. I think they import like 54% of their energy, right? But obviously, as tariffs and trade friction increase, they're going to look to diversify off of U.S. production as well, likely leading to a higher investment in things like those renewable diesel and SAF projects that you talked about. Because again, it's just cost normalizing costs, right? There's a green premium, sure. Well, maybe the green premium is not worth it, but the security premium could darn well would be worth it. And so ultimately, the price of that diesel made from penny cress or camelina is maybe it's 50% more than conventional. But that's not revolution worthy, right? Not having diesel is, and so you end up in a possible political instability if you don't have some solution. So I think it actually could be positive for some of these alternative fuels, because not everyone is quite in the U.S.'s camp and being as energy rich, and the U.S. has made it pretty clear that we're not going to make it super cheap for everyone in the world to get our energy. So I think there is this question that other countries are starting to think about of should they invest in some of these alternative fuels.
It's an interesting argument, which is if the United States is on the forefront of deglobalization, then does that mean all of these, relatively growing economies, are they going to start thinking about how they can produce resource locally? And that may just result in them doing, equivalently some all of the above approach. Maybe some things are higher on that cost curve, some things are lower, and maybe some of those higher things are also low carbon, hand in hand. And can you get that price down for them as well?
That's right. I mean, who knows? You can't really predict these things. My guess is you'll see some sort of new trade blocks forming, right? Already we're seeing that. We have a Canadian business that is affected by tariffs into the U.S. potentially. We don't really know how that'll play out.
Yeah, no, TBD, right? Like everything's on hold as of today,
Right.
and then we'll see when it gets punted again. Which
But that business is now being approached by UK and Europe and other Canadian companies, as well as groups outside of that, looking for building those lower friction environments to sort of offset. So I think some economies it's going to be really difficult just to produce everything in house, right? There are for most nations, but I do think there are blocks of nations that may sort of reform and retrench to create kind of trade blocks. Um, and ultimately, it depends on what the administration's goals are here, right? Are the administration's goals really to use these tariffs permanently, or are they a means to another end, right? And they may be, and we'll just kind of see how that plays out, because I don't think a world where I don't think a deglobalized world is really possible, but I certainly recognize we've bumped the limits of globalization a couple of times. There's probably some happy medium between those two that likely forms over the next couple of years.
So we're about to enter, call it Q2 now, 25. When you think about capital, either capital flows of energy private equity that's going out and fundraising, or capital that's dry powder that hadn't been deployed, where do you think we are in that cycle, right? Because it's tough to exactly tell. Now, part of this may be administration related and some of the changes, but where do you think the capital sits today? Is it eager to be deployed and sitting on the sidelines, or trying to
I think there's
find
a lot of
discovery? Yeah.
Yeah, I think there's a lot of cautiousness on the sustainable side. I think conventional energy, you're seeing a little bit of a resurgence, as we talked about. I'm skeptical you'll see sort of a full-blown re-push by all investor classes into the energy sector. And part of the
Yeah.
reason is I've been in the sector my whole career, so I can pick on it a little bit. It hasn't been the greatest returning sector over time either, right?
Yeah.
So even
Right. Yeah.
before this the climate push, it has been a disappointment a few times, and so
100%.
I
Yeah.
think that keeps people a bit on the sidelines there. But you're seeing more interest there. I think it's healthy. I don't think that complete abandonment of the sector is ever a good idea, because capital will come from somewhere, and you want it to come from good, responsible sources.
Right.
So I'm glad to see people starting to at least consider conventional. Now, on the sustainable side, I would say there's a lot of cautiousness. We are still very active. We're very excited about a few themes. I've mentioned some of that already. We still think carbon capture has a very clear place in certain industries. I don't think it's a panacea. I don't think it solves every problem, but it has some really great economic cases. I also think waste sort of upcycling is a really fascinating area.
And the same is actually true. I mean, if you think about carbon capture, when it's ammonia or ethanol, it is not that different than a waste business, right? Like it's your tailgate of the plant was going to vent this stuff, or we're going to put it in the ground, right? Like, here's the market opportunity.
Yeah, I mean, from a operating standpoint, right? Yeah, ethanol, ammonia, gas processing, natural gas processing, maybe a couple of hydrogen designs, right? There are a few designs where you've already got that pure grade CO2. Hooking a hose up and putting it in the ground, that's not expensive, right? That's a very low cost.
Do you think a lot of those nat gas processing, let's say there was a bunch of project announcements in the Haynesville, and they're all on TBD timelines in terms of when they, what their original projection of FID and where it sits, without saying anything confidential. What are the odds that you think a lot of those get done, or you think it's just going to consolidate to one or two, or how do you think about that?
It's a good question. I think so. Carbon capture's gone through this interesting kind of growth in the last few years. We've learned a lot about the subsurface that we didn't know, so we started mapping it, right? The EPA's learned a lot about what they even want to ask. I would say that you can see that in terms of permit timing, like the first permit's 5+ years. I think if a permit's filed today, it may be 18 months or less, right? So I do think you'll see a lot of carbon capture built around gas processing. But some of it has been just learnings around the plumes and how, there are some zones that we had identified early on as being very clear zones for disposal. And as we really got into those zones and started studying them better, we realized they've got much more migration than we thought. And that's a big problem. So some of this learning, but I still think for those three sectors, so ethanol, ammonia, and gas processing, over the next decade, I think 100% of that will generally migrate toward some kind of carbon capture. Outside of that,
to me, the Haynesville's got to be like, call it the, within that nat gas processing world, has got to be the lowest cost. Maybe the lowest cost is not the right analogy, but it's got to be like the most core acreage equivalent in my head, only because you got to treat the CO2 in the gas stream as it is, right? Like again, it becomes this waste to fuel argument, which is like, well, we already need to amine treat a lot of this stuff. Why don't we go? Yeah, almost like the H2S in the Delaware Basin, right? Like, we have to deal with this stuff. Well, now by virtue of dealing with this stuff, well, how do we deal with it, right? Can we just perhaps change the way we deal with it to sort of qualify for certain things that might drive us revenue?
Totally
and all
agree.
of a sudden you have an interesting business, right?
Yeah, that's right. And there are some rules around how the 45Q can be implemented that kind of precludes older plants from qualifying. There's a little bit of noise in there, but you're exactly right. Haynesville, anything north of 2% CO2, it has to be dealt with. And we've built a lot of acid gas injection wells back in the day to deal with hydrogen sulfide and CO2. So yeah, it's been dealt with. We know it. We know the science. It's not expensive. And that's why
There's
I
no
think
tech rates, right? Like these are this has been going on for a long time.
long time, and it doesn't cost. It's not costless, but the impact, sort of, you think about it, a cost per ton of carbon, the cost per ton of carbon is about as low as any application in the world, really. And
Yeah,
so,
yeah.
other than maybe getting new light bulbs, I think is probably the
Right.
best.
Yeah.
So yeah, we're very bullish on that sector. We continue to stay very active there. Again, waste is a fascinating one. I'm still a believer in biofuels, but I'm kind of a medium to long term believer. Like the near term, it's pretty turbulent, right? It's a tough time. But when we really look at where the UK is headed, where Canada is headed, where the EU is headed, they have some pretty clear demand centers that are popping up. I think even with the sort of cost of green, I think the cost of security overrides that. So I don't think those are going to change. I think if they can drive 10% of their fuel from sustainable sources, that's 10% of their fuel that's not coming from imported oil. I think that's probably viewed
I see.
as a positive. So I think you'll still see that. Again, not a panacea like most of these things. It's not
Yeah.
going to be. I don't see a world we could grow enough crop to handle our energy needs. We have massive energy needs. But I do see a world where those biofuels play a component. I think you'll still see electrification continue. Personally, I was originally fairly skeptical of the limits of electrification. I think the security premium probably drives more of that than I would have forecast, just from a cost perspective, because the cost is really high, right? I think we're starting to see there's a high cost to electrification, but nonetheless, that cost can be better than doing without power. So yeah, we'll see. But I'm fairly bullish on a few of these core areas: carbon capture within the sectors we talked about, waste upcycling. I think biofuels within a limit, and then there's a few other areas we're interested in. There's certain types of um, ag management, both sort of fertilizer supplies and ag waste, that we think can be very economic and impactful, looking at alternatives to your sort of traditional ammonia that could be quite economic just on a dollar parity without any incentives. And so that's some areas that we're interested in. There's some, science project things out there like geologic hydrogen that are pretty interesting. We're looking at some of those.
Yeah, there's obviously a lot of capital that's sort of flowed into that category. We'll see where it plays out. Is there anything from a sector perspective that you're bullish on and you wish there was a way for you to kind of back a team in that category? And maybe you get there, maybe you don't, but it sounds like you're more founder first than you are, sort of business planner sector. So that is a happy medium that you probably have to play with.
Yeah, no, we definitely start with swim lanes around the sectors, and then we try to find those teams that marry that. I would say it's really hard to answer that question in this turbulent environment, right? It's hard for me to say there's any one area that is a shoe in. I think that, if I had to look at an area that I think is somewhat overlooked because it's had some rocky starts, but I think it's going to have a really great future, it's sustainable aviation fuel. It's an area that a lot of people look at and kind of roll their eyes. They say the cost is too high. They say, the ethanol to jet and that technology is too new. That said, I think they may be underestimating just the power of the demand centers for that over the next 5 years. Between now and 2030, we see something like 8 or 9 billion gallons a year of new demand being formed, and right now the capacity of producing like 2 billion gallons, right? So there's a big gap, and I think that
it is an interesting, like, if you go in and just go look, like, okay, great, give me a list of like the top 20 SAF offtake deals and like go make that table, and you're like, oh, none of these are like actually, these are all like LOI, MOU, like let's hope maybe they'll get there. But
right.
it is an agreement that if this startup or you can kind of get there, you'll get there. But like they're not happening yet, right? Like they're not actually trading hands.
That, right? When you look at the way the regulations work, the teeth don't really kick in until 2027. So 27 is really when you start to see the pricing mechanisms come into play. And right now, I mean, if you're going to build today, you're maybe looking at a startup. So
Yeah, it's going to take a while anyway.
the buyers aren't feeling the pain just yet. And so they're
Yeah.
out there, they're active. You definitely see some of the airline groups being more active than others. But I will say that I would expect over the next 24 months, you're going to hear more of those turn into real contracts because the teeth of the regulations are going to start to really bite. And that's been the challenge. They've been out there for a long time, but they haven't been a problem until 2027. And
Okay.
so that's what we see sort of. That's why I say it's an area that's been overlooked. It hasn't really gotten off to the best start, but if I had to look at an area I think's going to hit its stride in the next few years, it's probably sustainable
Yeah,
aviation
this
fuel.
pending expected sort of regulatory and compliance market that should shift it differently, right? Or shift the
That's
view
right.
around it differently. Yeah.
And one I would have maybe argued that there was a risk to that just from a green premium being, is it worth it sort of question. But I think with this current sort of geopolitical environment, it will be viewed as equally green and security, augmenting kind of national security for some of these firms or some of these countries. Sorry. And so I think that's why I'm fairly bullish that over the next 5 years, you'll see that sector emerge as still a relatively niche sector. It's not going to be massive, but bigger than what we saw renewable diesel pan out to be, for example.
Yeah, I mean, even a small percentage getting blended in here is still, in absolute terms, quite a bit of fuel, right? And require a lot of businesses. I know you guys are notoriously spending most of your time, call it, molecule side. Has there been any discussion around entering in, call it obviously the last 2 years has been a lot of discussion around power, and probably the last year, just an insane amount of it. Has there been a thought around moving into power, let's say adjacent to a midstream business or something like that?
Absolutely. And I think for us, it is probably looking at it like a midstream business, right? We're probably not going into building power plants tomorrow, but there are things, whether it's some of the energy storage solutions that are economic, or at least can be economic in the right scenario, working to sort of bridge conventional and renewable together in certain ways. That's an area that's interesting. Some of the services work around these maintenance facilities, that can be pretty interesting for groups like us that are a little bit on the smaller side. So yes, we're very active in looking at the electron side of the world, just trying to make sure that we stay within our relevance in our wheelhouse. So where I would say that we've seen some of the more promising investment areas is around storage, and particularly so much has been focused on getting with regards to like lithium battery storage, right? Both bringing the cost of that down, and trying to get the cycle times longer, and there are alternatives to that technology that are maybe have very little energy density, right? They're very heavy. They don't work very well at all in a car, but they can be repowered a million times with no degradation, right? So there are alternatives that we're looking at that people have overlooked because it doesn't fit on a car, it doesn't fit in a computer, it doesn't fit on your phone, but it can fit great for a major data center or something along those lines, where you're really looking at instantaneous backup power while you're switching between sources. You're going between a renewable source and a conventional source. Those are some of the things that we find pretty interesting right now.
Have you spent much time on, call it, tossing on peakers onto the tailgate, so on some midstream side? And, I don't know if you've got assets in Texas or not, but it feels like that ERCOT's probably going to stay a mess for a little while, and there's probably an opportunity to generate some decent returns, playing energy storage, but more as a, on the nat gas side of the life or something.
We've looked at those in the past. I will tell you, as an infrastructure oriented investor, I don't have the stomach for it, but it's a great investment, and you can certainly look at it and say, odds are it's going to be a very
if you take a sliver of the fund and you put that towards that strategy, is probably going to pan out just fine. But just in case.
One of the things we've looked at is that with renewable diesel and some of those areas, so can you in those peaker times where you're less fuel sensitive, and you are trying to create something that still has a lower cost carbon, because it's not that every group has said they don't care about carbon costs, right? A lot of the groups we've talked about, Microsoft, Amazon, they're still part of the climate pledge, right? They're still trying to find ways to keep that. So those are areas where some of those peakers could be added in using renewable diesel in a way that is a lower cost option where that fuel price is the least of your worries, right? So yeah, that
Yeah,
fuel's a
right.
little
Yeah, yeah. So
expensive,
yeah, the
but it does.
backup. Yeah.
So we have looked at that. Today we haven't made any investments in that area, but we continue to monitor.
Well, that sounds good. Well, Chris, I appreciate you taking the time. Is there anything we didn't cover, or either professionally or personally that's exciting to you that might be good for the audience to know?
No. I think again, this may be edited in a different way because I don't know if it comes right to you. One area that I do think is worth maybe spending just a minute on is that missing middle, right? Because
Yeah.
we didn't really talk about that in a big way. But one of the things that for us, and you can see it when we sort of founded Cresta, and I still see it today as a big gap, is there's a lot of money raised in climate tech. There's still a lot of money raised in infrastructure. And then in that sort of middle area, once a technology has become, able to be commercialized and it's sort of ready for prime time, there's not a lot of capital there to start to get behind it, right? The climate tech groups are not set up to go put $100 million per instance each time you put a machine to work. And the infra funds aren't really in the building of things
No.
business, right? So what
The
we're
buyout
trying to
business.
do is really kind of bridge that gap. And we kind of joke that if we can go out and sort of stock the shelves with these really nice bite-sized, fully contracted commercial assets, then you have the much larger firms going up and down the aisles with, very big pocketbooks and somewhat empty grocery carts, right? Looking to fill their carts. And so part of our job in the next couple of years is really to help stock the shelves with those opportunities. And we see that more and more where the climate tech firms have come up on the end of their fund. They've got a great business, but it's not quite commercial. And we think we can really help in being a part of that next phase.
Do you think most of those are going to have to be some version of a cap restructure? Just because you sort of think about the vintages, right? A lot of money got deployed from those funds. If they're having a hard time raising, to the next phase, the suspicion is it's probably underwater in some capacity, at least from how much money has been put in. Might be a really good business, really bad cap table. Is that the opportunity set, you think, where that's the roll up your sleeves and try to figure out how there's a sort of control equity way to kind of control that business and recapitalize it the way call it a build and back business might be?
That's right. I think that's a big part of it, and obviously we're trying to be good partners across the board,
Yeah.
and I think that where you have funds, and we may have talked about this in the past, where a generalist fund, for example, that has some big wins in AI, but a big sort of question mark in climate tech,
They're not
if
going
we
to
can
stop
find a
you. Yeah.
way, right? But if we
Yeah.
can find a way to say, hey, let us come in, put some capital in, it's probably going to be first capital out, but then if it's successful, you've got a chance to sort of remake this big return as we deploy 4, 5, 10 of these units. That can be very attractive for a firm like that that says, okay, maybe I'm out of the money now, but there's a good opportunity once we get a few of these rolling. I have a back end interest that can get my money back, on the table. And so that's
Yeah.
something we're pursuing.
Depending on how much capital a venture fund is put in, venture is just so fascinatingly different than private equity, right? Which is, in PE, the idea of a goose egg, especially a material one, is like just keeps you up at night. In VC, it's like the difference between 0x and 1x is potentially not that big of a deal. Return of capital sounds great, but it lands a lot harder to people in Houston and Dallas than it does to someone in Silicon Valley, right? Because they're not in it for the 1x or whether 0 or 1 is sort of irrelevant. They're looking for some insane return profile. And so if it gives them an opportunity to sort of get out of that business and perhaps let the founder kind of take another stab at growing their baby potentially, they're probably less likely to stand in the way. Do you think funds are more constructive towards that? Or do you think it's tough for, my suspicion is it's got to be tough for a lot of founders to swallow the pill of effectively going from, I've raised a ton of capital on a non-control basis. I have full autonomy over the business. Perhaps it hasn't worked out the way they wanted, but they're also probably sitting back and saying, okay, great. Maybe they got some personal secondary or something. But the team recognizes that this is deeply out of the money, right? And so it is a weird, it's almost like the what you point out on the empathy point, right? These are like from a math and diligence perspective, there's probably a ton of these opportunities, but it's kind of that human string of like almost getting like a DSPAC deal done, where you kind of have to make everyone happy and then thread the needle to make it work.
Yeah. So our model is different, and we try to sell that to the founder that, rather than have to try to preserve some piece of the initial dollars and raise money at higher and higher valuations, if you just reset it and instead look to, earn more of a back end profits interest, now you're motivated for us to put large dollars to work, right? Yeah, because reality is, once we've made back a hurdle return, you've got a big denominator to start to earn value off of. And it's a different model, but it's very successful. And there are a lot of, very successful founders in the midstream world and the upstream world that have used that model.
A lot of houses in Highland Park and River Oaks that have been bought with B shares, Chris.
Absolutely. And so we just have to take them on a tour of Preston Hollow and Highland Park, and so yeah, it is a different model, and we have to be very thoughtful about the governance, and because we do have control kind of requirements, but we can do that in a way that gives the founder a tremendous amount of discretion and the ability to do what they want to do. So,
have you been spending a lot of time? It sounds like you've been spending a lot of time thinking about those, or trying to get to the finish line on those, or has that been a major? Because that'd be a little different than the build it back, right? In that same, call it, potential sector.
I mean, we have a couple of sort of live opportunities in that vein right now, and so it's top of mind because it's something that we're actively working through, and it's refreshing. I mean, I think for us, seeing this different business model and a founder who's gone through that, maybe has some different scars, and kind of working from a different perspective, we hope that we can find common ground and make those businesses work. But again, for us, coming back to the very first part of this discussion, all of this has to work. The business model has to work first, right? At the end of the day, my partner David always says to people, "There's not much in this world that's harder than to make money with a good idea," and he's right about that. Right? It's just not about the idea; it's about the grinding out of a good business model. And so, we, as much as I see some of those opportunities to bridge climate tech into infra, it's not going to work in every case, right? It's going to work where those business models really are commercial. They really are ready. And for various reasons, that older model just didn't work for where they are today. That's where it's going to make a difference.
Is there anything from a either conventional or new energy perspective that is a popular narrative that you are just like vehemently opposed to, and you're like, just like a hot, the equivalent of a hot take, even though it may not be that hot of a take?
Yeah. That's a good question. I mean, the one, I'm really not. I mean, I'm not a, you can probably tell I tend, my highs are not high, my lows are not that low. I have a lot of opinions, but I always test them and I want to see how they work out in the real world. What I would say though is, I am not convinced, just from my long history in the natural gas business, that we can ramp up gas demand the way we're talking. I mean, we're talking about adding multiples of the nation of Mexico in terms of new power.
It's a very huge amount of nat gas.
Yeah, and I think there is a massive cost component to ramping up that quickly, and I think ultimately there's going to be some governance on, some governors created on that growth, and I don't know how that sort of impacts the development over time. But that's the one area that I think, much like I never believed we would hit net zero as quick as everyone thought, because $100 trillion is still a lot of money. When you're talking, $80 billion a go, I mean, that's a lot of capital. And while it's not, that it can't be done, I'm just skeptical that we'll see that level of growth that quickly, because people have to eat, right? We have other priorities.
Yeah, that's right. And also, okay, let's sort of play the tape forward. There's a bottleneck on production right now for, like, it's never been a better time to own some sort of gas turbines or something. So, everyone is talking to GE and Baker right now, like, trying to skip the line. Okay, great. So they size up production just like anybody else. Okay, let's invest in more production, but that's going to take a couple of years to play out. History would tell you anytime this sort of happens, where people are willing to pay 2-3x for something today, and then in a few years we have an increase of that supply, it's going to go the other direction, and it's going to go the other direction very quickly. And then you're going to be littered with excess
problem, right?
Bingo,
Yeah, exactly.
So
Yeah.
I don't know how it plays out, but like if you sort of think about the base case of how it normally plays out, there's way more opportunities that we're wrong. We're over forecasting demand, and we're going to be littered with extra nat gas turbines we don't know, how to get online. That's what history would tell you in most of these markets. Now, there's another case which is like we're underestimating, what the needs are going to be and take it off. But again, like 1 gigawatt, 2 gigawatts data center, again, we're going back to the same problem, which is where is the $1 trillion of CapEx coming from, right? Like if you sort of say, okay, count up all the big tech companies and say each one of them needs to align $100 billion and then stack those obligations year over year over year. And you're like,
Every
you're
4 years,
approaching, to be clear, $1 trillion is what Howard Lutnick is in charge of bringing in new revenue using tariffs globally from a GDP perspective, right? Like we're not talking about numbers that make sense in market cap. We're talking about, GDP type moves. We're talking about what, Doge is tasked with cutting out of the federal government spending. This is an insane amount of CapEx. And that's annually. But it's not just that, right? It's the component before that, which is, where's the financing coming from for this stuff, right? It's going to be really, really tough, I think, to make sense of this
I
stuff.
agree. And I think when you start to look at the logistics too, this is materials. These are real physical buildings, right? So this is real graphene. This is real, carbon components that are very expensive. And so it's not just the money, it's ramping up capacity across the board, and turbines are the least of our problems. So again, I think it's something that you could see a steady ramp over the next decade and start to get to some level. But the idea of us going from flat-footed to full-scale development in a year or two, probably the best way it turns out is how it turned out every other time that this has happened. Right? So very likely we will miss it, and it'll miss up and down. I don't think it'll just be one direction. Yeah. So I think you'll have a lot of volatility in that sector. And we'll also see how the world is willing to monetize it, and where those real world applications come, and not to get too philosophical, but the counter effect too. Like once you start to have efficiency, effectively you're describing layoffs. So now who's buying the remaining product, right? So there's definitely a point where that model collapses. So yeah, I'm just kind of curious to see how that plays out. But my guess is it'll be, if I had to have a hot take, it's that AI boom is gonna boom much slower than we would like for it to.
That sounds like a fair assessment.
Now, very boring hot take.
It's the whale, right? Like it is, we don't want to be an AI business, but like you can make the argument that is 100% of growth accountability today, right? Like it is, without that narrative, do we need to grow? Right, is sort of the fundamental question.
Yeah, that's right. And honestly, if you start to see like efficiencies, again, I started looking at Industrial Revolution and then the sort of aftermath of the Industrial Revolution, which was the Depression, right? So you start to think about these cycles as well, and that's kind of my, I guess, fear of this boom is
that's right.
That who's going to fund it? Well, ultimately, who's going to fund it is corporations looking to create efficiency. As they create efficiency, that creates less of a buyer population.
15% of your workforce.
Right. We're a consumer-driven economy, and now we have fewer consumers. And you sort of step back and look at the planet from a true macro standpoint, and you start to look at our resources, and are we really driving our resources to the optimization of a TikTok algorithm? I mean, at the end of the day, is it that we're going to have global food scarcity because we really, really need that algorithm to work? And it just gets a little nonsensical.
That's right. Yeah. Like the max bet version of this is a very optimistic world, but also a very like potentially quite depressing thing to think about. But in the meantime, we'll just use it so we can get a little better research for our meetings 15 minutes in advance of the meeting or whatever.
And that's how I think will happen. I do think we'll continue to see AI boom relatively. I just think there are these natural governor points that will keep it from being quite the optimum. Just like the green boom of 2014 to 2021 sort of fizzled, and by today, I think you'll see something quite similar in AI. It's not that it's not going to keep being a major force. There's tremendous investment still in climate, right? Still today.
Yeah, it's just that you'll peak, right? Like the arms race of capex peaks, right? And the question is, do you peak in 2025? Do you peak in 20? Yeah, when is that peak? Because that lopsides all of the investment banking equity research reports on load demand, right? Like there is a bullwhip effect to this, right? And we are, again, it's like a barnacle on the whale, right? Which is the whale is. Yeah. What do these guys come out and come out at Davos and tell you what the capex number is? And we're like, okay, great, like that equals this, and like that's how this goes, and we're an input to that, and the entire ecosystem around is an input to that. But the second it slows, so does capital flows a little bit too.
Yeah, I mean, but what we've seen though, just as a practical standpoint, is like getting these things built, these data centers built, is a much bigger logistical challenge than a lot of folks who are recognized, because none of the grids want them, right? They don't want them on the grid because it's a massive demand center. So you have to be almost self-sustaining. And so now you're talking about building, an ERCOT over and over and over again, like 4 or 5 ERCOTs getting built over the next few years. And that's why I just say it's not that I'm skeptical AI is going to continue to boom. Of course it's going to. It's changed our species, right? It's amazing. But there are these practical limitations of how quickly we can actually move it, because the energy system is so delicately balanced. And each time you're trying to add something, you have to add the supply and the demand at the same time. And there's a lot of moving pieces. And it just takes time. So I think you're going to see some frustration, people wanting it to move faster. And ultimately, it's going to keep getting built out, but just at a little more measured pace than some of the analysts are forecasting. So.
Yeah, you can make the argument one new LNG project is, how many data centers, right? Like, think about relative scale, right? Like, it's insane, right? Like 200 megawatts and gigawatts, like 200 million a day. Like, no one gets excited about 200 million a day of new demand in this country, right? Like, what are we talking about, right? Like, that's a pad in, Marcellus Utica at this point, right? So
these days it is, yeah.
Yeah, exactly, right? Like, so, it's not that exciting. So the question then becomes, okay, great. Like you bring on a couple more of these LNG projects, but then again, that's, 6 years. Maybe you could reduce the red tape, to kind of get some of that stuff done, but it's still 6-7 year engineering project, to get done. So, okay, well, good deal. Well, Chris, I appreciate that. I'm sorry we ran over time, but it's been a fun conversation. Is there anything we didn't cover that you're personally involved with, that you get excited about, or you think you'd like to spread a little awareness on?
I really can't think of anything to kind of highlight. If I think of anything, I'll follow back.
Well, yeah, I'll reframe the question. Okay, so if you're talking to kind of call it the 18-year-old, 19-year-old, 22-year-old Chris, and maybe even 25-year-old, whatever, some young age, where if you were going to go and do something entrepreneurial or not, where do you think young professionals should spend some time thinking about or go chase?
Yeah, I think that much like we talked about early on, the idea of natural gas is just this really unique molecule, right? You said it's energy dense. We have a lot of it. It is relatively clean in that it has really one byproduct that can be managed. We can grab it and put it away. I think the idea of leveraging how to use natural gas more efficiently over the next few years, not just for power to AI, but all the different aspects. Natural gas is going to be a component of our energy grid, certainly through my lifetime, and I think through my grandchildren's lifetime. So that would be an area I'd say continue to stay involved in understanding, geoscience. I think that, you don't see a lot of folks going out today and becoming, geophysicists and geotechs, but all
even
of this
petroleum
stuff,
engineers, right? Like,
but all the stuff we talk about, it needs materials, right? We need to build. You got to mine. You've got to, You've got to find the materials and use them. And I think we're getting better at doing it in more environmentally friendly ways, but you still have to do it, right? It still has to come from somewhere. And so that's an area I'd push my kids towards. I say, stay the course of understanding how this all works, and don't get too caught up in the narrative one way or the other. Really pay attention to the big pictures.
Yeah, I mean, there's got to be a good cohort of computer science grads that want to transfer now into petroleum engineering or something. I mean, history would tell you, right? What is it? The smallest petroleum engineering classes always result in like the wealthiest founders, like 20 and
That's
30
right.
years later.
So
You know,
true. The cycle
and that's
like that.
probably always true, right? Like in virtually every sector, right? Which is you just have less competition, and the market's always going to be there at some point for you.
Well, these cycles, they can look mysterious and magical, but they actually follow very predictable, currents, right? So it's
Well,
like
this
the
is why
overbuild
Oak
turbo.
Tree, does what Oak
Yeah,
Tree does, right? Like it's Howard Marks. Yeah.
exactly right. Yeah. So I think that's probably one, is that as much as sustainability is the core of our
Yeah,
company today, I
sure.
still believe that we have to find a way to coexist with the sort of legacy systems that are there and not sort of turn a blind eye to them, right? We just have to find a way to do positive things in an economic way and continue to be relevant, and that means paying attention to everything, including conventional and sustainable. So
I mean, look, it's like kind of a hilarious concept, which is we talk about all of the above energy. You say, well, we have not yet peaked globally on coal, right? Like
that's
so
right.
so the thing that is the majority of power globally and is continuing to grow year over year.
Yeah,
We
that's
don't
right.
have anyone who comes to any energy conference and says, "Hey, I'm the representative for the largest uh largest energy producing industry," because
Exactly.
we sort of want to we want to think we're further along than we are, and I think
That's
that's kind of like the takeaway here, right? Which is that the narrative makes it sound like we're really far along on this journey, and if you sort of zoom out, like we're kind of not even really knocking out the first piece, right? Which is always like the question mark around like nat gas being transition. It's like, well, we haven't even, it's not the majority yet, right? Like it's one
that's
thing to
right.
say it's on its way out because it's the
That's right.
majority. It's like we haven't even knocked out coal yet. Like let's start
Exactly.
there.
No,
And then
that's
let's
right.
talk about knock it out.
Yeah. Well, yeah, it shouldn't be a surprise. Like when you look at those historical trends of how long it took for coal to displace whale oil, right? And how
Yeah,
long it took
exactly.
natural gas to kind of become a force. And yeah, it's no surprise, but it's going to take a long time. And the good news is we are making progress in every aspect. Um, economics and environment. I think both of those are important. But yeah, we're a long way from being able to ring the bell and say
Yeah,
we've made it.
100%. Okay. If anyone wants to, if anyone listens to the podcast, is highly interested in waste to fuel, wants to, sort of cutting edge management team, wants to reach out to Chris, what is the best way to reach you? Just you want to give your email, or is it, something else?
Yeah, so if someone's just reaching out, we have an info@crestafunds.com, and that I get copied on everyone that comes through there. So I see everyone that comes through info@Cresta Funds, and we have a couple of other folks that do as well. So yeah, would love to meet you if you're out there.
Sounds good. All right, Chris, I appreciate you. Take care.
Thanks, Raj. Take care. Bye.